Number 1. Bernie Madoff, former Nasdaq chairman and owner of Madoff Investment Securities LLC, ran the biggest Ponzi scheme known to mankind. He said to investors, "Give me your money and you'll get steady high returns no matter what happens in the markets." Basically, he took money from new investors to pay the steady high returns to old ones and rinsed and repeated the process. Not actually knowing what he did behind the scenes and getting the promised returns, the investors felt that Madoff was a Wall Street genius, the perfect finance pro. But this can only work as long as new investors invest and thus older investors get their returns. Then the 2008 crisis came and all the investors started pulling their money out at once. There was no more new money to pay the older investors. Thousands, including retirees and charities, lost 17 to 20 billion in life savings in an instant. The 65 billion bubble burst and he was sentenced to 150 years in prison in 2008, where he died in 2021. Number 2. Enron was the biggest energy company in the world at the turn of the millennium. But these guys just weren't satisfied. Jeffrey Skilling, the former CEO, focused so much on the stock price that he started committing outright fraud, like showing false earnings and claiming revenues from projects that hadn't even started. They partnered up with Blockbuster for a $110 million deal. The deal fell apart, but they didn't stop claiming profits from it. They also took on debt to generate new contracts as they already had claimed revenues from the older ones. But taking on debt reduces stock prices. So they created shell companies and literally dumped all of the debt on them to appear profitable on paper. This led to their stock jumping 56 and 87% in consecutive years, exceeding 60 billion in market cap. Then Jim Chanos, a short seller, read the reports and was convinced all of this was bullshit. Skilling sold his shares worth 33 million and the SEC took notice. The stock price started tanking and eventually Enron filed for bankruptcy, thus wiping out 11 billion and the rest owed to other people. Number 3. 1MDB, the producer of The Wolf of Wall Street. This was a government-owned investment fund set up in 2009 by the Malaysian PM Najib Razak for energy initiatives and urban redevelopment projects. It partnered up with big players like Saudi and Goldman Sachs and raised over 7 billion through bonds by 2013 with the help of Jho Low. But in 2014 and 15, they surpassed billions in debt and missed millions in bond payments. So Malaysia formed a multi-agency task force to investigate and found 700 million in Najib's private account. The Wolf of Wall Street was also funded by a company tied to Najib's stepson Reza Aziz. One thing led to another, and the US DOJ estimated that around 4.5 billion was stolen and laundered. In 2018, Najib lost the general election, was arrested and prevented from leaving the country, and Jho Low is wanted by the Interpol since 2016. Number 4. Wirecard was a German fintech and payments company founded in 1999. They claimed that they had 1.9 billion euros in trust accounts in the Philippines. When auditors checked, the money was nowhere to be found. They inflated sales and pretended that money came from third-party partners in Asia. At their peak, around 2/3 of their revenues were fake. After Financial Times and whistleblowers saw suspicious accounting in the Asian operations and KPMG found major unverified balances, they had to admit to their shenanigans. Once valued at 24 billion euros, their stock was now worthless and Wirecard had to file for insolvency. CEO Marcus Brown was arrested and the former COO Jan Marsalek fled and is now a fugitive. Number 5. Lehman Brothers and other banks gave out home loans to literally anyone, even people who couldn't afford them at dirt cheap rates. These are called subprime loans, meaning high-risk, low-credit customers who will likely not pay their loans back. Banks bundle up thousands of these loans and sell them to investors, saying that they are backed by people's mortgage payments. But they lie to the investors, saying that these bonds are AAA rated and 100% safe. Spoiler alert, they weren't. Eventually, the high-risk customers couldn't pay back their loans and housing prices crashed, making the bonds worthless. Lehman had invested heavily in these junk bonds and was now 600 billion in debt. They filed for bankruptcy and the stock market crashed, wiping out 16 trillion from US households. Number 6. LIBOR stands for London Interbank Offered Rate. It's the interest charged by banks when they give short-term loans to other banks. Basically, the global price for money. Top banks like Barclays, Deutsche and UBS would quote their rates. Then an average would be taken, which became the official LIBOR for the day. But the banks lied. If a bank wanted LIBOR to go up, they'd submit a higher fake rate and vice versa. They did this to make more profit on their trades by charging low rates, ultimately benefiting themselves rather than the global economy. But why does it matter? Because LIBOR affects everything. Your mortgage rate, student loans, credit cards, business loans, all were influenced by a number made up by the banks to profit themselves. This scam cost consumers and investors billions over many years. In 2012, the scandal broke, but big banks only paid 9 billion in fines. A few traders were jailed, but the biggest execs walked away rich. Moral of the story, unethically scam people, but only if you have the money and power to escape the consequences. Follow for more such stories and don't forget to keep it simple, stupid.